Live from New York City this morning. Good morning, good morning. The equity market bulls this morning, at least, with a lot to like. The tech earnings better than expected. Jobless claims come in. Personal consumption is looking pretty decent, and your equity market is positive. From New York, the countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open, with Jonathan Ferro.
Coming up, growth in America coming in slower than expected. Speaker McCarthy's debt plan passing the House, and Powell, tricked by pranksters posing as Zelensky. We begin with the big issue, the trade everyone loves to hate.
Big tech leaders.
Quite a big relief.
Encouraged by what Meta has reported.
Positive results from both Google and Microsoft.
The bar has been raised.
The fear going in was way stronger.
Rally for mega cap tech can probably go a little bit further.
The market is hearing AI and getting overly excited.
So excited.
Excitement around generative AI.
And we know what happens with frothy reactions, and they can be undone at quite short notice.
This is a space that's now trading at 35% premium.
You just can't justify, the valuations.
People are going to start looking for growth.
The problem is I don't think rates will come down.
We would take some chips off the table here.
We liked what we heard.
We'll be listening more closely for the rest of the earnings season.
Joining us now on the West Coast, Ed Ludlow. Ed, Meta getting it done.
Yeah, a lot of it is the strong second quarter outlook, right? So they're forecasting revenue of between $29.5 billion and $32 billion. Even at the low end of that range, they are exceeding Wall Street's expectations. As your guest alluded to, generative AI, artificial intelligence, a big focus. Mark Zuckerberg spent 6 minutes of his opening remarks on the call focused on AI and about 30 seconds on the metaverse. But he made a really clear statement, which is there's been a narrative that Meta has abandoned the metaverse, for which it renamed itself in October of 2021. He said that that is a simply false narrative. He sees AI and the work they're doing in the metaverse going hand in hand. More important for investors is they're believing the cost-cutting story, right? They lowered their expenses forecast for the year again, down to a top-end forecast of $90 billion. Reality Labs continues to be an issue for them. Sales at the hardware segment for AR/VR, which is also the driver of the metaverse, basically half of what the street was expecting. And Meta is saying that those operational losses from Facebook Reality Labs are going to continue to grow. But the narrative on cost discipline also goes with a narrative around them committing to invest in the infrastructure to power AI. And if you look across Wall Street and sell-side note reaction this morning, Jonathan, that's where they're going, along with kind of pretty good macro picture and some optimism about the rebound in ads and what they've done on the product side to drive user growth, but also eyeball time on the various platforms that they hold.
Ed, thank you. 27 minutes out from the opening bell. That stock is flying. We'll touch base with Ed again around the opening bell. Right now, that stock at 240. Back in early November, 88. Massive turnaround for Facebook, Meta, and Mark Zuckerberg. Joining us now, Crossmark's Victoria Fernandez, Samir Samana of Wells Fargo. Victoria, Meta gets it done. Microsoft gets it done. Is big tech validating some big gains year to date?
It's a great question, Jonathan, and I'm not sure I have a great answer for it because they have had such large gains in this sector, not even the sector as a whole, but these few names, these FANG names, have had such big runs this year. And you would think that most of any kind of upside potential has already been priced in to the stock. That's what we anticipated. I certainly was surprised at Meta's earnings. I did not expect them to have growth in users. I did not expect to see the positive news coming out of ads. And I would expect that a lot of those efficiencies that people heard, that had already been priced in as well. So I'm a little surprised at the gain that we've seen. When we look at some of the other companies, yes, you knew AI was going to be a big story. But again, I feel like they've had such a big gain. We've actually been trimming some of these names, not selling out of them, but trimming them because of the gains they've had so far this year. I just can't see them continuing to be leadership. The breadth line has become so low across the market that I think we're going to start to see some churning in that leadership position, and tech might pull back a little bit as we go through the year.
Samir, going into these earnings, we were talking about the cyclicality in some of these names. Then you look at cloud in Microsoft, doing okay. Ad spend in Facebook, Meta, doing okay. When you look at these numbers, what's the takeaway for you?
Yeah, I mean, look, I would say, we were excited about tech last year, during the fourth quarter when people were kind of selling it for tax loss purposes, because again, we pointed back to a lot of these secular growth stories, which to your point, don't really rely as much on the economic cycle, right? I mean, Internet of Things, 5G, automation, et cetera. I mean, these are all multi-decade trends that should, for the most part, remain intact. The only real question is what multiple you pay for these earnings. And last year, a lot of these were kind of thrown out with the bathwater. Now, I think, probably that same excitement for us anyways is on the energy side. We think we are in a commodity bull super cycle. We think energy trades at, kind of high single-digit multiples with the highest yield in the S&P. So I think you've got to kind of be somewhat price dependent. And from here, I think energy is the better play.
Facebook right now, 239. Samir likes energy. Crude, struggling just a little bit. We can come back to that a little bit later. Yields higher this morning by 7 basis points. Your 2-year back through 4%. Economic data out about 35 minutes ago. Mike McKee can break that down. Morning, Mike.
Good morning, John. I want to start with jobless claims because that's having an impact on the market. 230,000 after 246,000 the week before. It does suggest the labor market remains tight, and that is going to keep the Fed on alert. And the labor market being tight may have contributed to a stronger consumer spend in the first quarter than anticipated by many people. 3.7%, down from the overall estimate, but it is higher than we saw in the first quarter. GDP overall comes in at 1.1%. Now, people are saying that's weaker than expected, but the Atlanta Fed number that came out late yesterday pushed that number down to about 1.1%, and I wonder how many people would have changed their forecasts had they had the time. Business investment really weak, and the change in inventories is what really moved things in terms of the first quarter. Subtracting $1.6 billion from inventories instead of adding, you can see how much was added in the fourth quarter, and exports, little difference. The data basically say consumer spending is strong, and consumers are hanging in there. Do they continue? Businesses don't seem to think so. Business spending dropped off significantly. Trade, little change, as I mentioned, but the inventories crash sets the Fed up for a question. If the consumer remains strong, do companies start building up inventories again, and then growth goes up, and that pushes on inflation? Or do consumers fall back to meet what business expectations are? Real final sales, 3.4%. That takes out the inventory aspect of it, and that suggests we do see some strength. Now, here's the chart that I promised earlier on surveillance, John. This is the Atlanta Fed GDP now. Never mind the numbers on the chart, although they are pretty close at 1.3%. But look at the trend. We started the quarter, came into the year on a high note, and ever since then, the economy has been slowing down. Does that suggest that that's what we're going to see going into the second quarter and onward?
Something for the optimists there, something for the pessimists as well. Where does it leave the debate around the Federal Reserve? We caught up with Bob Michael at JP Morgan Asset Management. He made the case for a rate cut as soon as September. Take a listen.
Historically, from the last Fed rate hike to recession, it's averaged 13 months. We're saying that the last rate hike will be in May. By November, December, you'll be in recession. Midway to recession, the Fed starts cutting rates. That's how we get to something like September.
Victoria, that's the rate cut call. Let's go through the argument against that. Unemployment at the moment, 3.5%. Personal consumption, consumer, looking resilient, robust. You go through the earnings, Kimberly-Clark, Procter & Gamble, Pepsi, Coke, take your pick. Double-digit price increases, no pushback. Even Caterpillar out this morning. Cat saying this, 23 will be better than we previously anticipated. MasterCard spending through the roof. What's the argument for a recession and a rate cut based on what you're seeing right now?
So I actually do believe we're going to see a recession later this year. I don't believe with the rate cut call in September, but let's look at our leading economic indicators. I know you've been watching these as well. We're down 7.7% year over year on leading economic indicators. That is a level you don't typically see outside of a recession. You look at money growth. I know people will say, yes, but there was a huge bump in money growth because of all the stimulus that came into the system. That's true, but we're still seeing a decline in money growth. We're seeing a decline in liquidity. We had $1 trillion in liquidity put into the system in March. Over half of that has come out now, and we're going to have more liquidity come out of the market when the debt ceiling debate is over, because the Treasury is no longer going to be pulling out of their Treasury general account. So more liquidity coming out of the market at a time when there's probably more austerity coming than many people think. So you're going to have slowing consumer, even though they're not collapsing. Consumer is probably slowing. You're going to have more austerity, liquidity coming out of the market, tightening lending standards, slowing loan growth. You put all that together along with 475 and probably 500 after next week basis points of rate hikes working its way through the economy, I think you get a recession at the end of this year. But because the consumer continues to be there, it's going to give a little bit of a foundation. And I think it's a very short-term, weak recession that we have, which is why I don't think we're going to see the rate cuts in September, as you mentioned.
Samir, do they sound like good reasons to buy energy names?
Yeah, I mean, look, this Fed got transitory wrong. And so I think for them this time around, I think they've got to stay more hawkish for longer. It's almost transitory on the other side of it. Right now, they've got to view disinflation as transitory. They just cannot get this inflation, issue wrong a second time. So that's probably what keeps them on the sidelines with respect to rate cuts until probably the first part of next year. Now, that being said, when we bring it all back to markets, I mean, keep in mind that the stock market has had almost a 16-month head start on trying to discount a possible recession, right? If nominal GDP in dollars is still kind of heading up, maybe kind of peaking out, the equity market peaked in the first quarter of 2022. So you've been in this process for 16 months. So although you could see a lot of the economic pain in the second half of this year, I do think the equity markets, especially the S&P 500, is a good bit of ways towards discounting that.
Samir, why the energy patch specifically? Why is that something you're constructive on?
So we love the discipline from the producer side, both on the OPEC plus side and on kind of the U.S. shale side. They are time and again kind of opting for producing less at higher prices and, kind of prioritizing cash flows back to investors. And the fact that they traded such cheap multiples and such high dividend yields means you kind of get paid to wait even if there is a recession.
Samir Samana sticking with us alongside Victoria Fernandez. Let's get you some movers going into the opening bell. We're positive 0.6% on the S&P 500. Here's Abby.
Not surprisingly, John, it is all about Meta in that blowout quarter. Shares are absolutely surging. The best day since early February because, of course, this company, this stock, into the quarter up about 80% on the year. So no stranger this year to big moves. The messaging around the AI and the meeting of the metaverse that Ed Ludlow was talking about, plus cost cutting, plus they just beat right across the board, the revenue guide higher. Amazon up in sympathy, plus the strong cloud quarters out of both Microsoft and Google on Tuesday evening. This company, this stock, up higher ahead of that. Southwest Airlines, not so much, down 4.4%. They posted a wider loss of 27 cents versus the estimate of 22 cents. The December turmoil simply hitting this company. They're talking about lower bookings in January and February. Bright spot, March maybe looking a little bit better, but maybe folks don't want to get on those planes knowing the technology is outdated.
Abby, thank you. Coming up on this program, First Republic struggling to find a solution.
The FDIC and the Federal Reserve, it's a really tough dilemma for them. They're stuck between a rock and a hard place.
That conversation up next.
The FDIC and the Federal Reserve, it's a really tough dilemma for them. They're stuck between a rock and a hard place. Either choice is not very favorable. And so it's something that they have to weigh, which is going to have the least negative impact to the banking system and to the economy. It's the depositors, and it's the depositors over the insurance limit is where the focus is, and that's where the debate is at this time.
First Republic stuck in a standoff between Washington and Wall Street, both sides looking to avoid steep losses as the FDIC ramps up the pressure. Bloomberg reporting the agency is considering downgrading the bank, a move that could limit its access to the Fed's lending facilities. Bloomberg's Shanali Basak has more. Hey, Shanali.
John, if you take a look at First Republic shares, it is trading at 7% of its book value. That is after 2 days of brutal sell-offs, after very little answers after its earnings release. Now, the point you made about the standoff between the U.S. government as well as the big banks here is this inclination for the big banks not to step in more than they already have, which leads to that question about what's the end game. How long can this bank limp along for? And are there other necessary actions that need to be taken? Now, what we have reported about the FDIC and the potential curbing of borrowing limits via a potential downgrade of its status, it would only just make it more expensive and more difficult for First Republic to find more access to capital. And that is the story under the surface here. How hard is it for this bank to find capital via normal means, let alone extraordinary means? You are seeing the shares really get a break here, a little bit of a relief after that brutal sell-off. But again, it did sell off 50% 2 days ago, another 30% yesterday. So really, until there are questions answered here, a lot of nowhere to go.
Shonali, we haven't heard much from the bank itself. The earnings call earlier this week, you and I discussed it, no Q&A, big disappointment from the analyst, and clearly doesn't really involve much confidence when you hear something like that or don't hear what you want to hear on an earnings call. Shonali, I want to understand what the other big banks are saying. The big banks that deposited this cash at this institution, what have we heard from them?
You know, what's interesting is they're saying a lot of the same things that you're saying. They're pretty shocked that on Monday that there were no answers taken on that call and that there were so few answers for the road ahead here. So it's kind of amazing here that you have some of the biggest banking titans in the world sitting there with their heads scratching around this issue when they have billions of stake at the bank themselves.
Shonali, wonderful coverage as always. The stock is lower by 1.4%. In the grand scheme of things, that's meaningless for First Republic. That was a triple-digit name all the way back to early March 9th, I believe. Then a double-digit name, single digit, struggling to hold on to 562 on First Republic. Victoria Fernandez, Samir Samana back with us. Victoria, how confident are you that a name like that is ring-fenced and that's an issue for them and not an issue for everybody else?
I do think that we're not going to have this element of contagion that a lot of people are concerned about, but that doesn't mean that we won't have little ripples that go through the economy, especially when it comes to lending standards. Look at these big banks. They're not going to step in and help at this point, in my opinion, unless they get some kind of a federal guarantee. And let's admit it, they haven't been treated the best when they have done it in previous years. So I don't think they're going to jump at the opportunity to do this. Does it mean we get widespread contagion? I just don't think so. Some of these banks had put themselves, because of the risk parameters that they had in place and the choices they made, they put themselves in a very precarious situation. Not all banks are in that same situation. Let's look at PacWest that reported this week. They actually saw their deposits increase. So I don't think we can say that there's contagion, but I think we can say there's concern and what that means in regards to loan growth and lending standards going forward.
Where does it leave the Federal Reserve? This from Evercore. Evercore have this to say about next week's Fed meeting. We can't rule out the possibility developments around First Republic could unfold in a manner that would lead the FOMC to skip May while signaling a hike in June. Samir, how do you think about that, what this ultimately means for the Federal Reserve? The Fed still hiked after SVB. If there were problems here, would it stop them from hiking?
I mean, I don't think this issue is broad enough where it's going to get the Fed to skip next week. I mean, I think the Fed goes next week. We even think the Fed, hikes in June. What we would say more broadly is, I mean, look, there's a lot of regulation coming for smaller and mid-sized banks, and they are going to start acting as if that regulation is coming and as if they're going to have to hold higher capital, which will mean tighter lending standards. So I think, one, this is not a time to be kind of, bottom fishing on smaller and mid-sized banks. Two, I think, smaller and mid-sized corporations will have a much tougher time accessing credit. We literally just downgraded small and mid-sized, capital stocks in the U.S. last week, along with large. And then I think third, I think this just makes kind of that recession that we see in the second half much more likely. So, I know a lot of people point to coincident indicators like the consumer and the labor market. But again, keep in mind that it's those leading indicators that continue to weaken.
Samir, you've just described a bunch of reasons for why the Fed shouldn't hike. Never mind June, why they shouldn't hike next week. Why do you think they'll go in May and June despite everything you just said?
I think it has to do with their mandate, right? Their mandate is inflation. And if you look at inflation, it's just not coming down. If anything, operators have figured out a way to produce less supply while holding the line on pricing. So if the Fed's mandate is, what smaller and mid-sized banks are doing, that's one thing. But if their mandate is inflation, I think they've got to try to balance both.
Victoria, do you agree?
I absolutely agree on that. I mean, Look, PCE numbers that came out this morning is a perfect example of that. We saw consumer spending higher. We saw exports higher. Look at the PMIs that we got last week. The pricing components in the PMIs were higher for goods and services, and that's happened for the last 4 reports. So I think the underlying inflation, let's look at those core month-over-month numbers that we're getting. They may not continue to go down that many people anticipate they will. Maybe they plateau or maybe they go higher like they did last month. That is what the Fed is looking at. They've got wages still at about 6.5% according to the Atlanta Fed wage tracker. You've still got a decent strength in the labor market. So I don't think we have this downward trend in core inflation that the Federal Reserve is looking for. So I agree they go 25 basis points in May, and I'm not opposed to looking at a 25 basis points in June, depending on the numbers that come out. I think they're going to become more and more data dependent as time goes on.
Samir, let's put a bow on this. You described a bunch of dreadful issues in this economy, followed it up by saying Fed's going to go in May, Fed's going to go in June. And yet at the same time, people are plucking out arguments about short and shallow recessions from here, there and everywhere. Where does that come from?
I don't know. I mean, it's the one thing we can't figure out. I mean, it's the most wishful thinking that we've ever heard of. I mean, to have the Fed cutting interest rates, to have inflation be well under control, and then to also have earnings basically come in at 220 and the economy continue to grow. I mean, it's just not going to happen. So, in our opinion, one of two things does happen. You get a moderate recession, which takes care of inflation, allows the Fed to kind of stand pat and they cut next year, which allows the markets to recover into the end of 2024, not the end of 2023. Or the alternative is that things continue to remain resilient. The Fed has to go even further than markets expect to maybe 5.5, possibly 6. And then the resulting policy mistake is one that probably causes us all to have to rethink some of these numbers.
This is exhausting for us all. Samir Samana, thank you. Victoria Fernandez, to you as well. Thank you very much. 7 minutes out from the opening bell, equities up by 0.6%. Tech getting it done. The Nasdaq well supported through the week so far. Up next, your morning calls, and later, Invesco's Rob Waldner staying cautious on credit amid lingering banking stress. That conversation around the opening bell. The opening bell, 7 minutes away. 5 minutes out from the opening bell, doing nicely here on the S&P, on the Nasdaq, a real lift. That's the price action. Here are some of the morning calls. First up, BMO, downgrading Electronic Arts to market perform, expressing concerns about the company's mobile strategy. Piper Sandler downgrading Vornado Realty to underweight, expecting a challenging year ahead after suspending its dividend. And finally, KeyBank raising its Meta price target to $280, saying aggressive cost cuts are now being accompanied by improving revenue trends. That stock is flying, up close to 15% in early trading. Up next, upbeat tech earnings overcoming banking stress. That conversation up next with Rob Waldner of Invesco. Your opening bell just around the corner. Live from New York City this morning. Good morning to you all. About 20 seconds away from the opening bell. Equities positive here by 0.6% on the S&P. On the Nasdaq, absolutely flying. Big tech getting it done in a big way this week so far. The Nasdaq 100 positive by 1.2%. From New York City, the opening bell rings. Switch up the board and get to the bond market. Yields look like this on a 10-year. 10-year Treasury yields higher by 4 basis points, 349.20. On a 10-year. Dollar stronger, euro weaker, just about holding on to 110 right now on a single currency. Crude positive 0.6%, 74.71 on WTI. Let's get straight to this session. 10 seconds in, positive 0.6% on the S&P. On the Nasdaq, positive almost 1 full percentage point. One stock to watch at the open around the tech story. It's Meta. Shares rallying on better than expected results. Mark Zuckerberg, the CEO, saying this: a stronger financial position will enable us to weather a volatile environment while remaining focused on our longer-term priorities. Ed Ludlow, we've got some growth.
Yeah, we've got some growth. The stock up more than 14%, which would be its best day since early February, and $77 billion of market cap added back to this name that had a really hard 2022, but has been resurgent so far year to date. It all started with that outlook for the fiscal second quarter, revenues of $29.5 to $32 billion. Even at the low end, that came in above street expectations. On the call, Mark Zuckerberg speaks for 6 minutes about AI and then 30 seconds about the metaverse. But actually, probably the star of the show was the CFO, Susan Li. A lot of emphasis on efficiency. You look at the expenses forecast. Again, it's been lowered from $92 billion for the year to $90 billion for the year, CapEx 30 to 32 billion. They're telling a story of how this is paying off, but they need to invest on an ongoing basis in the infrastructure to support AI. One point that's not really been discussed this morning, Jonathan, is about the ad market. So there's signs of strength, right? They're driving traffic to their platforms. But remember, we're lapping soft comps. What was happening this time a year ago, the war in Ukraine had started, which had a profound impact on the advertising industry. Lapping those soft comps makes the kind of near-term outlook a lot more attractive. But there is evidence that on the user base, from an ad engagement perspective, this is a company that's doing good at its bread and butter and is excited about AI.
What a move, approaching 240. Ed, thank you. Looking forward to the coverage from you and the team a little bit later. Meta, just working the Bloomberg for you, just quickly, now the best performing stock of the year on the S&P 500. Facebook, up close to 100% on the year. It was second to NVIDIA, knocks NVIDIA off the top of the pile. Meta up by close to 98% year to date. This morning, up 13. The South Side weighing in on this in a major way, as you might expect. This is one of the analysts, the team at Piper Sandler, saying this, boosting the price target and saying the following. Meta successfully passed the baton from cost cuts to revenue re-acceleration. This is the really important point. The business is now operating better and executing faster with fewer employees. Following another impressive print, Meta remains our top pick in digital advertising. That's the team at Piper. That's the stock right there, up by close to 14%. Let's stick with the earnings. Want to get to another name. Shares of Southwest under pressure after reporting bigger than expected quarterly losses. An operational breakdown delaying December flights, resulting in a $380 billion hit. Abby on top of the story this morning. Hey, Abby.
Hey, John. Well, yeah, and that 5% loss on the day, that's the worst day since the beginning of March. So investors not liking this, in fact, down for a third day in a row. And it has everything to do with that wider loss that you're talking about, a loss of 27 cents per share versus 22 cents. Earnings were roughly in line, but that December turmoil, if you recall, people stuck in airports, even one bride missing her wedding because of their faulty technology, that cost them $380 million. Now, relative to bookings, it also hit bookings in January and February for the reason that perhaps folks were nervous to get on one of their planes. Not surprisingly, John, this means that we do have the shares of Southwest Airlines underperforming other airlines year to date at a loss. The other airlines up a little bit, in particular United doing well. And I just want to throw in a little bit of breaking news related to transportation. Mobileye, the automobile software company, plunging down, had been down more than 30%. At that point, a record low. They cut their revenue outlook, and some are saying blame Tesla.
Abby, thank you. Southwest is down by close to 5%. Let's go to the industrials. This from Caterpillar, topping profit estimates, delivering some upbeat commentary too. The CEO saying this about 2023. 2023 will be better than we previously expected. Katie Greifeld has more. Hey, Katie.
Hey, John. Well, Caterpillar beat on profit and then some. Just to go through the numbers here, adjusted EPS came in at $4.91. Just for some context, the average analyst estimate was for $3.82. So a big beat there. And it was so good, actually, that analysts are worried it won't last, which might explain why shares are currently down about 4% or so. You had Baird in particular warning that Caterpillar's, quote, outstanding margins may not be sustainable. But regardless, the first quarter, at least, of 2023 was super strong. There had been question marks, of course, over construction demand, particularly in North America, which is Caterpillar's biggest segment. You can see, though, that year-over-year sales growth came in at 31.5% in North America, though, with volumes climbing for other regions as well. And that's good news, given that Caterpillar occupies this global bellwether for the economy.
Wall Street is a funny place sometimes. So good that maybe this is as good as it gets. The stock is lower by 3.7%. Katie, thank you. I want to turn to financials. One name has dominated the conversation. It's First Republic, looking to snap a two-day skid that wiped out more than 64% of its market cap. Bloomberg reporting the U.S. regulators are considering measures that would potentially curb the bank's access to the Fed's lending facilities. The stock this morning, Shanali at least, positive for once.
Yeah, absolutely. That's after it had lost $1.9 billion worth of its market value in the 2 days alone, John. This is now a bank worth about $1 billion, trading at about 7% of its book value. So sorely beaten in the last couple of days alone. Now, where do we go from here? If you take a look here, what's interesting is if you think about First Republic selling all or parts of itself, if it were to sell loan books, what would people buy? Remember, this is a bank that is very heavily exposed to residential, commercial real estate. A lot of those residential loans were also interest only. We're hearing a lot of folks in the market are worried about being able to make money off these loans at the end. So then where does the FDIC fall in? If they are selling all or parts of the bank, what kind of assistance would the government be able to provide if we get to that point? Now, remember, the question is, if this were to continue on a downward trajectory, what is the end game? What is the contagion effect here? We have seen a lot of stemming of issues in the banking system, but the point at which you started at here, curbing access to potentially the Fed's borrowing facilities, or FDIC's borrowing, you have an issue of capital when it comes to the banking system. Now, do other banks also face similar fallouts as well? I think that's what you are worried about at the end of the day, access to capital being constrained, as well as what is the broader ripple effect should this bank face more pain in the coming days.
Just turning negative as you and I talk. Shinali, thank you. It's just one of those names at the moment. You just keep up on the screen and just keep watching through the session, all over the place, just about turning positive again on the day by about 1/3 of 1%. The broader market story, 7 minutes into the session, we're up by 0.7% here on the S&P 500, on the Nasdaq positive by more than 1% for good reason. Big tech so far, massive weightings of these indexes. Big tech so far doing big things. Microsoft, then Meta, Amazon a little bit later, one to watch. I want to talk about credit briefly. The banking fallout, keeping Invesco's Rob Waldner cautious on credit. Current spreads seem to compensate for potential risk, including recession and volatility in the banking sector. We favour higher quality investment grade corporate credit over high yield and bank loans. Rob, the risks of a global recession, how pronounced do you think those risks are this morning?
Well, John, I think we need to look at what we're actually seeing is that growth is coming out pretty good. We got GDP data today that was not fantastic, but it was pretty solid. Consumption was good. And we are seeing continuing momentum in the economy. So while recession is a risk, it's a risk for us. It's not the key. It's not an expected outcome. It's just a risk.
How does that stack up with what you're expecting in the Treasury market, Rob?
Well, the Treasury market is caught between the Fed and the disinflationary environment that we're in. So, John, I think we need to think about where we actually are, which is an environment with okay growth and disinflation in our view, versus what expectations might be out there for the Fed and what their forecasts are. And the Fed is keeping rates very high at the short end while we have disinflationary forces and slow growth keeping the long end down, and we're keeping this inversion. And the Treasury market's really caught in between those two. So medium term, great value is available now in the Treasury market. Real yields are some that we haven't seen for quite a long time, but for now, we think we'll be a little bit in the range.
Bob Michael of JP Morgan was on this program yesterday, made the case for recession before the end of the year potentially, made the case for a rate cut by September, made the case, Rob, for the 2-year, the whole curve from 2s all the way out to 30s to drop to 3%, and maybe threaten to break that level and have a 2 handle on Treasuries, 2s all the way out to 30. Rob, does that resonate with you at all?
So I think what can happen here towards the end of the year, Jonathan, that could get us into that kind of environment is that if inflation continues to come down as we expect and growth stays positive but not exciting, the Fed will get into what we'll start to call maintenance cuts, because as inflation comes down, real rates at the short end will get higher and higher if nominal rates stay unchanged. So as inflation comes down, we might start to see the Fed follow inflation down if they get some comfort that inflation will continue to come down, and that's what we expect.
So, Rob, that would be the call that would lead to a shift in the yield curve eventually. Rick Reeder of BlackRock was thinking about some of these issues, and he said something interesting in yesterday's program. When we had a conversation about where to take yield, what pockets of the market, how much duration you want to take, he said we're in one of these really strange situations where if you give up cash yields and go further out along the curve, you give up yield. Now, Rob, that speaks to something you were talking about with the inversion of the yield curve. Rob, can you speak to that? What's the argument to go further out along the curve?
Well, the argument to go further out along the curve is that the Fed will pivot here at some point, and when it does, those overall rates will come down. I think that I would like to add into it a bit of a sort of credit spread conversation, because if you add in the credit spread that you can get in a sort of high quality corporate bond out the yield curve, you can get pretty good returns. So even year to date, investment grade credit is up 4%, I think, in total return terms. So that's beating cash very handily. So if you continue to get that kind of performance going forward, and what you really need there is stability in rates, spreads to stay stable, you can get some very good returns.
Stability in the banking sector would be nice as well. Big conversation this morning, Rob. I'd love your input on. Is there an argument for the Fed to pause as soon as next week?
Well, I think the Fed, we believe the Fed will pause next week. I doubt it's about the banking system will be the decider, though. I think it's becoming increasingly clear that these are idiosyncratic events that, if you're running a levered book, which a bank essentially is, you need to make sure that your financing is very secure. And for First Republic, their financing was not secure. They've seen this big deposit outflow, and their overall cost of funding has increased dramatically. And so even leaving aside the asset side of the balance sheet, you need to make sure that your funding is secure. And if you don't have secure funding, when that funding either increases in cost or it becomes harder to get, then the problems on your asset side of the balance sheet come to the fore. But that is not all banks. So funding is secure in the system in aggregate.
Yeah.
It's just not secure for a few particular institutions. And I think that's the thing that we're missing. It's about the funding is causing issues in these banks, and the funding is not a problem for the system overall.
Rob, can I ask one final question?
Yeah.
SVB failed. Credit Suisse failed. Signature Bank failed. First Republic's facing some problems. Can I ask you this? How many banks would need to fail before it was no longer idiosyncratic?
Well, I think you'd need to see some sort of brewing trouble in some of the larger, the larger banks, probably before we got to that in the U.S. that were caused by these factors sort of building momentum, and we certainly don't see that.
Rob, it would have to go that far for you before you turn around and say, we got a big, broad issue here.
Well, so Jonathan, but it is about the funding of. So the question I think you asked me is it systemic? And for the system as a whole, funding I think is quite secure. If you continue to get a lot of stress in regional banks, would it cause some issues in certain sectors of the economy, such as real estate, some local small and medium-sized enterprises? But those are certainly headwinds that we could see in the economy resulting from this. But I think we need to differentiate between the sort of systemic issue and, an impact on growth. And that's what I'm trying to do.
Got it. Understood. Rob, thanks for your time, sir. As always, Rob Waldner there on the latest in this market and the banking issues as well, and the Federal Reserve next week. A lot to get through. About 14 minutes into the session, up by 0.6% on the S&P. The Nasdaq doing nicely. Coming up, the debt debate heating up.
The Senate could pass our bill or send us something that they have, and we'll go to conference. Otherwise, we've done our job.
Speaker McCarthy in conversation with AMH down in Washington, D.C. a little bit later on this afternoon. We'll catch up with Anne-Marie next.
This is Bloomberg's The Open. I'm Lisa Mateo, live in the principal room. Coming up, Hertz CEO Stephen Scherr. That conversation at 10:30 a.m. Eastern, 3:30 p.m. in London. This is Bloomberg.
Now he should sit down and negotiate. We passed this early. We are in April, way ahead of the debt limit. We just passed the bill. It's not our job to modify it. The Senate can pass our bill or send us something that they have, and we'll go to conference. Otherwise, we've done our job.
Speaker McCarthy, his debt limit bill passed in the House, kicking off what is likely to be a long standoff between the two parties as lawmakers call on President Biden to come to the table.
Happy to meet with McCarthy, but not on whether or not the debt limit gets extended. That's not negotiable.
Bloomberg's Anne-Marie joins us now from Washington, D.C. AMH, do you get the sense the president's coming to the table anytime soon?
Well, what's interesting about the president's comments yesterday, this was a speech about really foreign policy. He's standing there next to the South Korean President Yoon, but he didn't mention the budget. He didn't say the Republicans still haven't addressed a budget. What he said was we need to make sure that default is off the table. So potentially there's a little bit of an inching, Jonathan, towards some sort of meeting of the minds, at least, of that these two individuals can get in a room. Remember, one of Speaker McCarthy's biggest gripes right now at the White House is that they not have had another conversation since February 1st. What he was able to do yesterday was really a political victory. It's the start of this debt debacle, though. We should not think that we're anywhere near this getting over with in Washington. He was able to coalesce moderate Republicans, far-right Republicans around his bill with one vote on the floor. And really what he's saying now is we were able to pass a bill that does raise the debt ceiling. Obviously, there's a lot of fiscal cuts in that the White House does not want to see. It's dead on arrival in the Senate. But really, it's an opening moment for the White House to start to potentially say, OK, we're going to have to negotiate. But the Republicans were able to get a vote on the floor, and it was able to pass.
There were tons of doubts about him getting it done. We were talking about this. Yeah. Never mind asking the president to negotiate. He had to negotiate with his own party. Gets it through. Anne-Marie, you're going to catch up with Speaker McCarthy a little bit later. I think it airs at about 5 p.m. Eastern time on Balance of Power with Joe Matthew. I'm really looking forward to this conversation. What are you looking at getting at with Speaker McCarthy later?
I think one really key point in this debt debate for the speaker and what's going to make his job much harder is you saw how hard it was for him to get Republicans to coalesce around this bill. If he is able to negotiate with the president, so many provisions in this bill, Jonathan, are never going to fly with the Democrats. So at some point, if he is going to be able to negotiate with the president, he's going to have a much weaker bill that he will need to get through the House. And I think that's where it's going to be much harder for him to get the likes of the Freedom Caucus on board. And he has such a slim majority, he can only lose 4 votes. So that is when it's going to become very tricky for him. Yes, he had a political victory yesterday, but now it just gets harder.
AMH, thank you. Down in Washington. Looking forward to the conversation a little bit later. Another story out of D.C. this morning. Take a listen to this. Federal Reserve Chairman Jay Powell held a call with a pair of Russian pranksters posing as the Ukrainian president. This according to video that's been shown on Russian state television. The Federal Reserve put out this statement. Chair Powell participated in a conversation in January with someone who misrepresented himself as the Ukrainian president. Fed spokesperson went on to say it was a friendly conversation and took place in a context of our standing in support of the Ukrainian people in the challenging time. No sensitive or confidential information was discussed. Mike McKee, I want to bring you in on this. Also important to point out that the Fed also said the video appears to have been edited. Can't confirm it is accurate. Mike, your response to this as this story continues to develop?
Well, there are a couple of things. One is, did Powell discuss anything that he shouldn't have discussed with someone who wasn't the head of state? The Fed says no. I guess we take them at their word for now, but I'm sure the Inspector General would like to ask some questions about that. The other is, how did they get through to Jay Powell? Now, apparently this duo in Russia has done the same thing with a number of other people, including ECB President Christine Lagarde and former German Chancellor Angela Merkel. So they have some way of getting past the guard posts and getting to these policymakers. The issue will be how do they do it, and how do you stop it in the future? Does this rise to the level of a real problem for the Fed? I'm not sure it does, but it could if there was something else to it to happen. One thing to keep in mind, too, is this took place in January, so anything Powell was talking about then probably doesn't matter now.
Well, I think that's part of the story, actually, Mike. What have we only just found out? Was the Federal Reserve aware in January that this was a prank, or only became aware overnight that it was a prank?
That we don't know. We don't know when the Fed found out. I mean, this only just aired on Russian TV, so obviously there was some significant delay here. And again, we don't know what Powell actually said. As you mentioned, the tape edited and it's all dubbed in Russian. But it is an interesting situation.
Amazing. What a story. Mike McKee, thank you. A story we'll stay on top of. Just to repeat, the Federal Reserve saying the video appears to have been edited. Can't confirm it is accurate, but acknowledging that Chairman Powell participated in a conversation in January with someone who misrepresented himself as the Ukrainian president, according to a Fed spokesperson. overnight. Just unbelievable. The broader equity market looks like this on the S&P about 23 minutes into the session, positive by 0.8%. On the Nasdaq, up by more than 1%. A lot of big tech earnings. They continue. Apple next week, Amazon after the close. Your trading diary up next. "26 minutes into the session, doing nicely. So far, so good. Up by 0.8% on the S&P. On the Nasdaq, positive by 1.27%. Meta flying. Let's get into the trading diary. Coming up a little bit later, Amazon, Intel, Snap reporting after the close. PCE, inflation data, UMich, consumer sentiment, personal income and spending numbers Friday. Plus, the Fed publishing its review on Silicon Valley Bank, all leading up to the Fed's latest rate decision next Wednesday, followed by Apple results the following day. From New York, that is it for me. Thank you for choosing Bloomberg TV. This was the countdown to the open. This is Bloomberg.